First give you a summary of what I'm going to say in the next 45 minutes. The summary of the structure of this presentation. We will start with the basics of savings, investment and wealth creation. Then we will look at investors' expectations, what investors expect when they invest money in various assets like bank deposits, gold, real estate, equity, mutual funds, etc. We will examine in some detail the risk-return characteristics of various asset classes, the risk-return profile of various asset classes. Particularly, I will be emphasizing why equities outperform other asset classes in the long run, though risky in the short run. Why they outperform other asset classes in the long run will be emphasized. Then we will move on to the tax implications of investments through the mutual fund, the strategy of systematic investment plan. Then we will conclude by looking at the emerging economic scenario, the prospects for the economy and the markets going forward. And after the presentation, I will take questions from you. I will be glad to answer the questions. Let us start from the basics. Basics of savings, investment, and wealth creation. Saving is the balance in income after meeting expenses. Investment means deploying money with the expectation of returns or profits. Wealth has many dimensions, but we are looking at wealth from the financial economic perspective alone. From the financial perspective, wealth means abundant, valuable possession. Valuable possession in abundance is wealth. It is very important to understand that wealth is created, unlike income. It is important to distinguish between earning income and creating wealth. Income is earned. Whatever might be our profession, whatever might be our occupation, whatever might be the job that we do, you work and earn an income. That's why we say income is earned. Wealth is not earned, wealth is created. Wealth is created through systematic, disciplined investment. Financial history tells us that the best way to create wealth, phenomenal wealth, is to make disciplined, systematic investment for the long term. It's not possible in the short run, but disciplined financial investment can give a fortune at the end of a long period of, let us say, 10 years, 15 years, 20 years. So that's why we emphasize this point. Income is earned, wealth is created. Any investor can create wealth. Now, why do we save and invest money? I'll be very brief here. We save money and invest money because we have to beat inflation. Inflation is something that we have to live with. And if you are getting 7% return on your investment and there is 7% inflation in the economy, well, you are not getting anything. You are not getting any return in real terms. You are getting 7% nominal return, but real return is zero because 7% is a return, 7% is inflation. So a good investment is an investment that beats inflation. If inflation is 7% and the annual return is 10, 11 or 12%, it will be a good investment. To make our money grow, we will have to invest. And all of us have our financial goals, our aspirations. We want to have a house of our own. We want to buy vehicles like a car, and there are a large number of modern gadgets these days which all of us want to possess. Then these days everyone loves travel and vacation. That is expensive, that you need money for that. And very importantly, education is becoming expensive. Education for the children. And marriage also is very expensive in our society. So marriage expenses, for all these purposes, you have to save and invest. Also, retirement planning is very important these days because the life expectancy is increasing. The day of reckoning will come. Therefore, it is ideal to start saving and investing much before the age of retirement. And finally, when we retire from this world, it will be a satisfying experience to bequeath our wealth to the next generation. This is why we save and invest money. Now, what do we expect? What do investors expect when they invest money? Whatever might be the asset class in which we invest. It can be bank deposits, it can be equity, it can be bonds, it can be debentures, it can be gold, it can be real estate, whatever might be the asset class. What do we expect from investment? Mainly, a good investment should have 5 characteristics. Investors expect 5 things from investment. These are: 1, returns; 2, capital appreciation; 3, liquidity; 4, safety; and finally, tax breaks or tax advantages. Let me explain in very briefly let me explain this. Return is a regular income from investment. You deposit money in a bank and you withdraw interest every month. That is a return. Capital appreciation means the value of the asset class in which you have invested money should appreciate over a period of time. Land is an asset which will appreciate in value in the long run. It has capital appreciation. Liquidity means the ability of an asset to be converted into cash at short notice. So a liquid asset can be converted into cash. Land gives long-term capital appreciation, but it is not a liquid asset. When you want to convert it into cash, well, it will be difficult to sell, or buyers may be hard to come by. Safety doesn't need any explanation. You should not lose your hard-earned savings. Your principal should be safe. And tax advantages are tax breaks available for certain investments. I will explain this in detail later on. So these are the 5 attributes for a very good investments. There is no asset class which can give you all the 5. That is very rare. But blue chip stocks and equity funds, balanced funds, can give all these 5 advantages in the long run, not in the short run. In the short run, there can be negative returns sometimes, very low returns. But in the long run, from equity and equity funds or balanced funds, if you are prepared to remain invested for 5 years and above, it is very much possible to get very good returns, excellent capital appreciation, very good liquidity, great safety, and tax advantages also. Let me very briefly tell you about the important asset classes available for investors in India generally. The important asset classes are bank deposits, doesn't require any explanation. Equities are stocks of companies, shares. Then there are bonds and debentures, bonds issued by the government of India, bonds issued by public sector undertakings, etc. Debentures issued by publicly limited companies, private sector. Then there are mutual funds, which I will explain in detail: equity funds, hybrid funds, debt funds, etc. Then insurance should not be looked at as an investment. Insurance is more a hedge against, precaution against unforeseen contingencies of life. Then there is gold, and gold, you can invest in gold now through the sovereign gold bonds, which can give you a return also, apart from capital appreciation in the long run. Then there is the real estate, about which we know, which can give good returns in the long run, but liquidity can be a problem. And recently in India, new products like REITs and InvITs have been launched. REITs are real estate investment trusts. InvITs are infrastructure investment trusts. These are mutual funds. Real estate investment trusts are mutual funds that invest in real estate. InvITs are mutual funds that invest in infrastructure projects. But these products are in their infancy in India, just started. It will take some time for these products to become popular and to become acceptable to the investing public at large. If you look at the important asset classes like bank deposits, gold, equity, etc., well, you will find that some asset classes score over others in terms of returns, capital appreciation, tax breaks, etc. I have a slide which explains all this. You can see a link on the right. If you click on the right, the whole presentation will be available, and in the presentation all the details are given in the slide. I'm just giving you some examples. If you take bank fixed deposits, for instance, presently the annual interest on bank deposits is around 6.75%. The risk on bank deposits is very low because very seldom banks fail in India. Diversification is not there because bank deposit is a single product. There is no possibility of capital appreciation in bank deposits because you are withdrawing interest periodically. There are no tax benefits unless you choose to lock your bank deposits for 5 years to avail of the ATC benefits. And there are no capital gains. And in fixed deposits, liquidity is very, very low because you are locking up your fixed deposits. When it comes to post office the deposits, the return is around 7%. Risk is nil because the investments are guaranteed by the government of India. There's no possibility of capital appreciation because safe investments like bonds do not give much capital appreciation, and there are no tax benefits also. When you come to public provident fund, you will get around 7.5, 7.6% return. The risk is almost nil because the investments are guaranteed, and there is no diversification, there is no capital appreciation. But a major benefit from public provident fund is the tax advantage. When you invest, 1.5 lakhs are exempt under ATC, so exempt when you invest. When the income accrues, the accrued income also is exempt from taxation. And finally, when you redeem your investment, that capital appreciation again is the income that you get, the value of the proceeds also is exempt. So it is exempt, 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 triple E. And that makes public provident fund attractive, but there is a problem regarding liquidity. In public provident fund, you have to lock in your investment for a long period of time, 15 years. So PPF scores very lowly when it comes to liquidity, even though it scores very high as far as tax benefits and risk are concerned. When it comes to direct investment in equity, history tells us that a 16% CAGR, compound annual growth rate, is possible. In India, if you take from 1979, when Sensex was 100, to the present day, the average annual return is around 16%. So that is what you can expect in the long run. But in the short run, nothing can be guaranteed. It is quite possible that in one year, the return can be 5%, very low, 2%. In 1 year, there need not be any returns at all. It's also possible that during certain years, there can be negative returns also. But in the long run, it is possible to get 16%. That is a historical return in India if you track the returns from 1979 onwards. And the risk is high in the short run, but I would say the risk is very low if you are a long-term investor with an investment horizon of more than 5 years. And diversification is a strong point as far as equity investment is concerned, because if you are investing in stocks, you can invest across industries, across the sectors, and therefore the diversification principle is can be followed, and the benefit of diversification will be available. Coming to capital appreciation, the possibility of incredible capital appreciation is there as far as equity investments are concerned. Some returns can be mind-boggling. It is possible to get capital appreciation from a single stock or from a few stocks, much more than perhaps what a person can earn from his entire working career. It is possible. I am a person who would even go to the extent of saying, and I am talking from personal experience, it is possible for a good investor to make more money from investment than all the money that you will be earning from a professional career spanning 30, 35 or even 40 years. That is possible, provided you are a good investor or a disciplined long-term investor. The tax benefits and capital gains tax benefits on equity investments I will be explaining separately. Coming to mutual funds, again, in the long run, medium to long run, mutual funds, equity mutual funds and hybrid funds, balanced funds also, I will explain this again later on in some detail, also can give very attractive returns of more than 15% in the long run. And the benefits of capital appreciation, diversification, and the tax breaks are available for mutual funds also. A fundamental principle of investment is, don't put all your eggs in one basket. Because if you put all your eggs in one basket, and unfortunately if you drop the basket, all the eggs will be broken. Therefore, conventional wisdom tells us to spread the risk by investing across asset classes. So you should not be investing in a single asset. You should invest in a select portfolio of asset classes. So it will make sense to invest in bank deposits, gold, ideally through the gold exchange traded funds or gold sovereign bonds rather than jewelry, because investments in exchange traded funds and sovereign gold bonds can give much better returns than jewelry. Of course, you can't wear the gold bonds and exchange traded bonds. That difference is there. So you should be investing across asset classes. If you have deep pockets, you can invest in real estate, you can invest in public provident fund. So how much money you should invest in which asset class? That is an important question. What we call asset allocation. How much of your investable funds should be invested in bank deposits, how much in bonds, how much in equity, how much in mutual funds, how much in gold, how much in real estate? That is the crucial question. And the answer to that question is, your asset allocation should be based on your investment goal, your financial goal. For what purpose are you investing? For instance, if you are in your early 30s, both the husband and wife are employed, so it's a double income family. And your children are 4 years old, 5 years old. And if you are planning for the college education of your children, you have a long time span here, very long time span of, let us say, more than 15 years. So if you choose an equity mutual fund or a hybrid mutual fund, a balanced mutual fund, that will serve the purpose. Because in this long period of time of 10 years, 15 years, equity mutual funds and balanced funds, and if you have the expertise to invest in stock directly, direct investment in stocks can give incredible capital appreciation which no other asset class can give. On the other hand, suppose you are a 55-year-old person and you will be retiring at 56 next year. This is not the time that you should be investing in equity mutual funds or directly investing in equity. You should be reducing your exposure to investing in equity, and you should be investing more in fixed income because you are on the verge of retirement. Therefore, where you should invest money and what proportion of your investable funds should go into various asset classes will depend on your financial goal. What is the financial goal? Is it construction of a house? Is it going on a vacation? Is it the education of your children? Is it the marriage expenses of children? So depending on that, you have to choose the asset class. A rule of thumb principle, a general principle of investment is you should invest more in high return, high income asset class like equity and equity hybrid mutual funds in the early phase of your career. In the early stage of your career, your risk appetite is low because you are young. Therefore, your risk profile is different from the risk profile of a person who is about to retire. So in the early phase of your career, invest in high return, high risk asset classes like equity. Let me repeat this point. High risk is only in the short run. In the long run, there is no risk. The risk is very, very low. And as you advance in age, the exposure to risky assets like equities and equity mutual funds should be brought down. And as you approach retirement, the exposure to fixed income like bonds, debentures, etc. should be increased. This is not a fundamental principle applicable to everyone. Depends on the risk appetite. It is quite possible that a 65 or 70-year-old person has a very high risk appetite because of very sound financial position. Therefore, there is no fundamental general principle like that. But this is a general principle which can be borne in mind. In the early phase of your career, invest more in high risk, high return assets like equity and equity funds. And as you advance in age, reduce the exposure to equity. And when you are about to retire, invest more or increase the exposure to a fixed income. But one thing is very clear. Long run wealth creation is possible through investments in equity, through investments in either direct investments in equity if you have the expertise to do that, or investments in equity through the mutual fund route. Let me emphasize this point. Financial history tells us that equity outperforms all other asset classes in the long run. Why is this so? The reason is very simple. When you are depositing money in the bank, fixed deposit for instance, you are lending money to the bank. The bank gives you 7% return as interest. The bank lends at, let us say, 10% on an average. So 3% is the bank's profit, net interest margin. You will not get a share of the profits of the bank because you are lending money to the bank. If you are investing in a small savings, for instance, like national savings certificates, you are lending money to the government. And the government is using this money mainly for financing the deficit in the government's budget. Governments usually run deficit budgets. So small savings are used by the government to finance the deficit in the government's budget. It is not used for wealth creation. It is not productive investment. When you are buying gold, when you are investing in gold, particularly if you are buying gold jewelry, it may be a social necessity, particularly in our society, but you are investing in an unproductive asset. It is not an asset that creates goods and services, but it is a safe haven investment. It is a hedge against uncertain times. It is a haven during uncertainty and volatility. So it is advisable to invest, let's say 5 to maximum 10% of your investable funds in gold. But we must remember it is an unproductive asset. But because of the scarcity of gold, the shortage of the total stock of gold in the world, when the demand goes up, the price appreciates, and in the long run you get very attractive capital appreciation. But when you are investing in equity, you are not lending money, you are buying ownership in a company. When you buy the share of a company, you become the owner of the company. When you're buying a share of, for example, Larsen & Toubro, you are becoming the owner of Larsen & Toubro. So when companies grow, when their revenues grow, their profits also will grow. When their profits grow, the share prices appreciates, and you benefit from capital appreciation in the share price. You benefit from the dividend that you get when companies distribute their profits in the form of dividend. And that is why equity investment outperforms all other asset classes in the long run. Incredible capital appreciation is possible. New investors who do not know this may be surprised to know that an investment of 9,500 rupees in 100 shares of Infosys in 1993, when Infosys made their initial public offering, 9,500 rupees investment in Infosys in 1993 is now worth more than 5 crores of rupees. Incredible capital appreciation. It is very difficult for new investors to understand and appreciate this. As they say, truth is stranger than fiction. It is applicable to the markets also. So that's why I said at the beginning that wealth is created. This is an example of wealth creation. Of course, there are cases of wealth destruction also. If you choose the wrong stock to invest, it is quite possible that it results in wealth destruction. So this is the reason why equities outperform all other asset classes in the long run. In one of the slides in this presentation, when you click on the link, you will see that slide. It gives you the comparative returns from bank deposits, gold, and stocks during the last, let us say, 38 years. I have taken the year 1979 to start with because in 1979, Sensex was 100. Now it is around 33,000. Suppose a person bought gold for 100 rupees in 1979, invested 100 rupees in a bank deposit, and bought shares, Sensex stocks, 30 stocks represented by the Sensex in 1979. What is the situation now? Today it is possible to buy the index. You don't have to buy the stocks. You can buy the index. You can buy Nifty, for example. You can buy the index. So you don't have to buy the stocks which constitute the index. So 100 rupees invested in gold in 1979 by March 2015 had appreciated to 1,987 rupees. That means it has multiplied 19 times. Bank fixed deposits yielded around 9% return during this period. It would be worth 2,225 by March 2015, multiplied 22 times. By the end of March 2015, Sensex was 27,957. That means it multiplied 279 times. If you take the present index level, it is now around 33,000, having declined by 10% from the peak. So with Sensex at 33,000, what does it mean? It means Sensex has multiplied 333 times during the last 38 years. This is the kind of phenomenal capital appreciation that happens in the long run. So Sensex has given a return of around 16% during the last 38 years from 1979. Base year for Sensex is 1979. That's why I chose the Sensex, because it is a longer history. We started economic reforms in India from 1991 onwards, and after that Indian economy started growing at a much faster rate. Since 1991, if you take the last 27 years, India is the second fastest growing economy in the world, second only to China during the last 27 years. And corporate profitability has increased substantially. So since 1991, India's GDP has multiplied 10 times, and Sensex has multiplied 33 times. In 1991 it was around 1000. Now 33,000 means it is multiplied 33 times, because corporate profitability always increases disproportionately. Now the logic, the economic and financial logic behind this wealth creation, this phenomenal capital appreciation, is what is called the power of compounding. The power of compounding is simple compound interest, simple mathematics, but it is very difficult for people to comprehend. The power of compounding, it's called the magic of the power of compounding, because it is very difficult to believe. For instance, to give you an example, suppose a person invested 1,000 rupees for 30 years. That means 360 months. 1,000 rupees every month for 30 years. At the end of 30 years, if he gets, or if he got 6% return on his investment would be worth 10 lakhs. His investment would be 3.6 lakhs of rupees, 360 months multiplied by 1,000 rupees. At 6% return, his investment would be worth 10 lakhs. At 10% return, it would be worth 22 lakhs. But if the return is 15%, the corpus would be worth 70 lakhs, 70. The difference between 10 and 15 is only 50%. But the difference between 22 and 70 is more than 300%. This is the power of compounding. This is something which 99% of the people find it difficult to understand. That's why Albert Einstein called the power of compounding as the eighth wonder of the world. And this is the reason why investments in equities and equity products like mutual funds creates big value, phenomenal capital appreciation, create wealth in the long run. In India, mutual funds have given more than 15% returns consistently over a long period of time. There are many mutual funds which have given even 20% returns over a 20-year period. Now let us move on to the tax implications of investment. Equity investment has many tax advantages. Dividend from equity investment up to 10 lakhs is completely tax-free. You don't pay any tax on dividend income of 10 lakhs. So 10 lakhs is completely exempt, dividend income. Long-term capital gains has been till March 31st completely exempt from tax, but in the new budget, long-term capital gains tax has been introduced. But even long-term capital gains tax introduced this year is only 10%. So if your long-term capital gains in 1 year exceed 1 lakh, you pay 10% long-term capital gains on your capital gains beyond 1 lakh. Up to 1 lakh, you don't pay any long-term capital gain. What is long-term capital gain? Long-term capital gain is the profit that you get when you sell a stock at a profit after holding it for a period of minimum 1 year. If you keep it for 365 days and sell after that, it is called a long-term capital gains. And 1 lakh is completely exempt. Beyond that, you pay only 10%, very reasonable. But if you sell within 1 year, then it is called short-term capital gains, and it is taxed at 15%. I'm talking about investment in equity. But if you are investing in equity mutual funds, well, again, dividends are not completely exempt. Formerly, dividends were exempt. Dividends from equity funds, dividends from balanced funds, hybrid funds, and dividend from arbitrage funds, I will explain that later, are taxed at 10%. Long-term capital gains and short-term capital gains in the case of equity funds are the same like taxation on equities. That means long-term capital gains beyond 1 lakh are taxed at 10%, and short-term capital gains are taxed at 15%. Now, if you come to debt funds, equity funds that invest in debt instruments like bonds, debentures, money market funds, etc., well, the long term is 36 months. If you remain invested for 36 months and invest after 36 months, 3 years, then indexation benefit is available. That means your real return will be calculated as nominal return minus inflation. There is a formula for calculating indexation benefit, and you pay 20%. For those people who are in 30% tax bracket, suppose you are in the 30% tax bracket and you are getting 7% interest on your bank deposit, you have to pay 30% on the 7% interest income. But on the debt funds, you pay 20% after indexation benefit. So the actual tax incidence will be around less than 1%. So it is highly attractive for long-term investors. Long-term is important. You have to remain invested for 36 months. But a dividend, you should not be opting for dividend because dividends are taxed at 25%. So if you are investing in debt funds, opt for the growth scheme and not the dividend scheme, because the incidence of tax is higher in the case of dividend schemes. In India, during the last 25 years, there has been a paradigm shift in India's economic performance. In India, equities started outperforming other asset classes like bank deposits from 1980s onwards. At 1990s, our growth rate moved to a higher trajectory, and the corporate profitability also started growing hugely. As a result of that, returns from the stock market increased substantially. As I told you previously, since 1991, to the last 26 years, India's GDP multiplied 10 times, but Sensex multiplied 33 times. So investors who remained invested during this period got substantial returns. But unfortunately in India, only a small minority of Indian investors benefited from this phenomenal wealth creation. Many foreign investors benefited. Foreign portfolio investors are allowed to invest in Indian stocks. So they have been investing very aggressively because foreign investors have a lot of confidence in the India growth story. So foreign portfolio investors, foreign pension funds, foreign endowment funds, they have been investing in India. They have benefited substantially. A minority of retail investors in India, high net worth, knowledgeable investors have benefited. But large segments of Indian population have not benefited from this incredible wealth creation that has happened in the Indian market during the last more than quarter century. This large majority of Indians did not benefit because they did not invest. That is as simple as that. They did not invest and therefore they did not benefit. Therefore, it is very important that investors should invest and benefit. But then let me make one point very clear here. Direct investment in equity needs two things. You need two conditions for successful investment in equity. One is you need expertise to do that. Second, you need time. Vast majority of people do not have the expertise and the time for direct investment in equities. If you have the expertise and time, go ahead and do that. It can be a very rewarding experience. If you don't have the expertise and time, the best option would be to invest in the market indirectly through the mutual fund route. So the mutual funds in India have given market-beating returns, consistent returns over the last more than 20 years, 25 years since mutual funds have been allowed to, private mutual funds have been allowed to invest in India. I already referred to mutual funds very in a detailed manner, but I did not tell you what mutual funds are. Let me tell you what mutual funds are. In very simple language, mutual funds mobilize the small savings of investors and invest this money in accordance with the investment goals of the investors. I explained the investment goals earlier. So depending upon your investment goal, your financial goal, your money will be invested either in an equity fund or a hybrid fund or a debt fund or a liquid fund, depending on your financial goal. So as I said, initially in the early phase of your career, you should be investing more in equities and equity-oriented funds, and as you advance in age, reduce the exposure to equity and invest more in fixed income instruments. Now, an important issue in investment, mutual fund investment, is what should be the ideal strategy. Many invest 17, the Nifty gave a return of around 29%. So now the market has corrected 10% from the peak. Units at a lower price. So when the market goes down and if you continue to invest systematically, if you remain invested, if you invest regularly, you will be getting units at a lower cost. And later when the market goes up, it will later on, and your lower cost will give you a very good appreciation in the long run. So SIP is very good for long term. Then there are ELSS, equity linked saving schemes, which will give you tax break under section 80C. And the advantage of SIP is it is for the Aam Admi, it is for the ordinary person. You can start with a small amount, as low as 500 rupees a month, and it is ideal for a long-term wealth creation. And for SIP, the earlier you start, the better, because the power of compounding will work its magic in the long run. Now there is a consensus now globally that India will be the fastest growing economy in the world for many years to come. In the coming year, financial year 2018-19, the IMF and the World Bank and most think tanks have projected a growth rate of 7.3 to 7.4% for India's GDP growth for the coming year, 2018 and 19. And this will be the highest growth rate among large economies in the world. And India is likely to be the fastest growing for many years. And when this kind of growth happens for many years, when the economy grows, when companies grow, profitability grows, phenomenal wealth creation will happen. In 1991, when we embarked on economic reforms, when we initiated liberalization in India, the net profit of India's corporate sector, that is, the net profit of all companies put together, was 6,400 crore rupees. Just 6,400 crores. Now there are many companies which make more than 10,000 crore profit in 1 year. There are some companies which make more than 6,000 crore quarterly profits, a few. The net profit of the Indian corporate sector is now around 4.5 lakh crores. From 6,400 crores in 1991, and now it has reached 4.5 lakh crores. And it can be in the vicinity of around 10 lakh crores by 2022-23, the next 5 years. It is very much possible. There is again a global consensus that India will be a 7 trillion economy. Our Niti Aayog has made a projection of a $10 trillion GDP for India in 2030. 2030 is just 12 years away. There are many think tanks which have projected a $7 trillion GDP for India. It is very important to understand that when we got independence, India was a very small economy. We touched the $1 trillion mark in 2007, after 60 years, after independence. The next 1 trillion came in 8 years. 2015-16, India became a 2 trillion economy. Going by conservative estimates, barring unforeseen circumstances, India can be a 7 trillion, 6.67 trillion economy by 2030. It is quite possible that we exceed that figure. If we can sustain a growth rate of more than 8% and touch 10%, even $10 trillion is possible. That is what China did. Our market cap is market capitalization, the value of all the listed stocks in India, in very simple language, is now more than $2 trillion. So when the GDP touches, let us say, $7 trillion, it is quite possible that the market cap also can be $7 trillion. The simple point that I am trying to convey is, in the next 12 years, by 2030, it is quite possible, it is not probability, it is quite possible that Indian economy can be more than 3 times bigger than what it is now. Market capitalization can be more than 3 times what it is now. That means in the next 12 years or so, the Indian markets will create more wealth, or 3 times more wealth than it created during the last 67 years. That means it is a historical opportunity. What is in store for India is a historical opportunity to create phenomenal wealth for the next 10 years, 15 years. We should participate in this wealth creation. Just as foreign investors are participating in India's growth, Indians should participate in India's growth in this wealth creation. And the simple way to do that is through investment. Direct investment, if you have the expertise and time to do that. Otherwise, invest indirectly through the mutual fund route. And if you are opting for the mutual fund route, the ideal strategy to invest should be systematic investment plans or SIPs. Thank you very much and best wishes. Now we go to the Q&A session. We have some questions ready already. Let me read the questions, 4 or 5 questions, and I'll be happy to share my responses to these questions. First question is SIP or lump sum. I touched upon this point in my presentation. What will give better returns at the end of 10 years, lump sum or monthly SIP? Very difficult to say because it depends on which time context you invest. SIP is a foolproof investment. If you are making an SIP investment, go for SIP. Don't think about anything else. It will give you very good returns. But suppose the markets are trading at very low valuations, not now. Presently, I will not advise you to make a lump sum investment. But if the markets are valued attractively, like what it was in 2013, when the price earning multiple, PE ratio was very low, valuations were attractive, there was a right time to make a lump sum investment. So the market corrects, let us say, by another 10%, it may be a right time to make a lump sum investment. Otherwise, continue with SIP. SIP is always safe. Second question is, if mutual funds give better returns than bank FDs, if debt mutual funds give better returns than bank fixed deposits, which category of debt funds are suitable alternative to bank fixed deposits? I touched upon monthly income plans in my presentation. Monthly income plans, MIPs, are a form of conservative debt investment. If you are a long-term investor who can remain invested for a minimum of 36 months, if you opt for this conservative debt fund called monthly income plan, MIP, 80% of your money will be invested in fixed income like bonds, debentures, etc., high quality, high credit rated fixed income. So the safety part is there. 20% will be invested in blue chip stocks, very high quality stocks. So in this 3-year time horizon, that will give you superior returns. Plus you have this inflation indexation benefit also. So your ultimate tax incidence will be very low. So that will be an ideal investment for investment in debt mutual funds. But here the condition is you should be prepared to invest for a minimum of 3 years. But if you need the money within a very short period of time, then you can park your money in liquid funds. Liquid funds are funds which give you returns similar to bank deposits, but the advantage is you will be getting 6.5% without locking in your money. You can withdraw your money at any point of time. Liquidity is very high. You can get money within 24 hours. Another question is, with the introduction of long-term capital gains tax and dividend distribution tax, when investing in mutual funds, which investment option should I opt for? Growth option, dividend option, or dividend reinvestment? The long-term capital gains tax introduced in this year's budget and dividend tax on debt funds has made this option very, very important. It's a very, very relevant question now. Presently, it doesn't make sense to opt for dividend scheme in debt funds, because particularly for those who are in a 10% tax bracket. Because in the debt funds, the short-term tax depends on your income tax bracket. If you are in the 5% income tax bracket, you need pay only 5% tax on your short-term capital gain. If you are in the 20% tax bracket, you pay 20%. If you are in the 30% tax bracket, you have to pay 30% short-term gains. So the dividend option is not a desirable option. Go for a growth option, because there is no tax on dividend, because dividends are taxed at 20%. Another question that has come is related to what I have explained here is, what is STP? Is it better than investing in lump sum? STP is systematic transfer plan. There are some people who want to invest a lump sum because they would have got some unexpected money, some windfall gains, some unexpected money, and they want to make that investment for the long term. The question is, should we invest in installments over a long period of time, or should we make a lump sum investment? That again depends on the context. It depends on the market situation. If you ask me this question in the current context, I would say STP is desirable, because market valuations are high and there is the probability of market correction. 2018 will be characterized by high level of volatility, unlike 2017, because there are a large number of reasons for this volatility. Therefore, if you invest in a systematic transfer plan, what happens in a systematic transfer plan? Your money, let's say you want to invest 5 lakhs of rupees. This 5 lakhs is invested in a liquid fund, ultra short term, liquid fund. And this liquid fund will be giving you, let's say, 6%, 6.5% return. And every month you will be transferring, let us say, if you opt for an SIP of 50,000 rupees every month, over 10 months, 50,000 rupees into 10 is 5 lakhs. Over the 10-month period, your systematic transfer plan will be completed, and you will be getting the interest on the remaining balance. If you're opting for an SIP of 25,000 rupees, it will be invested in 20 installments. So the market valuations are high like they are now, even after the correction. It makes sense to invest through the systematic transfer plan and not lump sum investment. Of course, if you are a long-term investor who have a time horizon of, let us say, 7 years, 10 years, it's always possible to make a lump sum investor if you don't lose your sleep when the market comes down. But I am emphasizing this point because in this particular year, 2018, there is the probability of high volatility, and therefore systematic transfer plans will make much more sense than a lump sum investment. Another question is, what is the right time to invest? This has already been explained. If you are investing through systematic investment plan, any time is the best time. There's a joke, the best time to invest was yesterday, but you can't invest yesterday. Therefore, the best time is today. Tomorrow never comes. Therefore, if you are a long-term investor, start your systematic investment plans today. Approach your financial investor. Tell your financial advisor what your financial goals are, and your financial advisor will tell you the right kind of product which is suitable for you for realizing your financial goals. And the last question is, as a young parent, when and how can I start investing for my children's education? I am very glad that as a young parent you have started thinking about your children's education. Your children must be very young now, since you are a young parent. This is the right time to think about the education, higher education. By the time your children go to college, professional education particularly is going to be very, very expensive. So the right time for you to start investing, start with a small amount, whatever you can afford. Start a systematic investment plan in an equity fund, a large cap equity fund, or a flexi cap equity fund, or a balanced fund, what is called a hybrid fund. It's a combination of an equity fund and a debt fund, and remain invested till your children start going to college, and you won't be financially stretched for your children's higher education. Congratulations to you for thinking about this with a long-term perspective. Thank you all for participating in this webinar. Thank you very much.